Even though YouTube is one of the best places to learn, I'm going to share what most people on YouTube will not tell you about real estate investing because they either lack the experience or a true understanding of what investing is. The almighty douchebag, Grant Cardone. First off, here's what I'm going to say. If you think Grant Cardone is a good investor, I'm not the channel for you. You need to block my channel. You need to put this away because nothing in this world is going to save you. Grant Cardone is a massive idiot. He has no idea what he's talking about, and I can say that with absolute confidence in this world. And one thing he always said is 6% is greater than 0%. Okay, guess what? Not true. Here's why, especially in the world of real estate. He was making that based on 0% in T-bills at the time. Well, you remember what happened to that? All of a sudden, the Fed came out and they jacked up rates from 0% to 5.5%. So if you made a real estate investment based on a 6% return because it was better than zero, what happened when rates went to 5.5%? Guess what's happening to your real estate? It's still generating 6%. It wasn't being affected by this. In fact, I would argue that when T-bills was 0%, your real estate was worth a lot more than when T-bills were 5.5%. That's the issue. And the other thing is, how easy is it to sell real estate and buy real estate? Can you do it at the drop of a hat? No, you can't. It takes time. So you locked in that 6% rate. You're sitting there saying, I got a 6% rate, which is great because I'm getting 0% in my T-bills and my cash. Okay, great. Now all of a sudden rates went up to 5.5%. You're still at 6%. Is 6% better than 5.5%? Sure. But let me ask you a question. How much more work are you doing for this one versus this one? That's my question. Real estate takes time. At least with stocks, you can exit a stock like that and go buy a better investment. But with real estate, it takes time to sell things. And then at that point, if you're like other investors, another investor goes, wait a second, why would I get a 6% return here when I can get 5.5% by sitting on cash? Spoiler alert, you're probably not going to get as much money as you'd like on your real estate deals. So don't focus on 6% being better than 0% as why you buy. Second point, what's the most important thing we hear about real estate? Location, location, location. Absolutely wrong. Absolutely wrong. And here's why. Because this becomes a justification for paying whatever price is necessary. Pay whatever to get in there. Guys, if you're buying an established property, the rents and the money you make from there are already going to be factored in on where the location is. People sit there and think, I got to have the prime real estate. You know what? When I was on real estate boards before, and I would sit there and talk on these panels, there was one guy that always stuck out to me because I really respected him. You know what he said to me? He goes, Paul, said to the crowd, we're trying to get 8 or 9% returns. I was like, that's it? He's like, yes. But we're buying the most valuable real estate we can find in the most prime locations. And I was like, okay. What I loved about him was he was honest. He's like, guys, we're overpaying. That's why we're making 8 or 9% returns because we want to buy properties that we know will never, ever go away. With that guarantee is lower returns. Guys, I wouldn't get out of bed for 8 or 9% returns in real estate. I wouldn't even touch it. What am I trying to get? I'm trying to get 15%, 20% or more. My best real estate deal ever was in a crappy location, and guess what? I'm getting 40% returns. Why? Because the one thing that matters is price, price, price relative to value. That's what matters, not location, location, location. This will get you to overpay because all you'll sit there and say is, yes, but look at this location, and you'll start paying more for the same income. Another very common thing I see on YouTube, Instagram, TikTok is talking about something called passive income. And I always hear people say, I want passive income through real estate. Does not exist. Even if you invest in a fund that goes and buys real estate, you still have to sit there and do some work. What's going on with the fund? What returns you're getting? Are they hitting their goals? There's no such thing as just literally collecting money unless you buy T-bills. And guess what your returns on T-bills are right now? 3.5% to 4%. That's the only way to get passive income. Or buying a low cost dollar cost averaging into ETFs. That's it. Other than that, with real estate, even if you buy a property and you give it to a third-party manager, which we'll get into shortly. But if you get to a third-party manager, you have to manage a third-party manager. You still have to look at how's the property doing? Are they doing the right things for the property? Are they raising rents? Are they keeping expenses reasonable? There's no such thing as passive income. Absolutely not. And you might sit there and say, well, Paul, I'm busy with other things. I don't care. No such thing as passive income. Well, Paul, I can go buy a REIT. Maybe, but is that really real estate investing? Yes, you're buying an asset that has real estate fundamentally below it. And that could be passive income to you. But even then, I'd sit there and say, just buy a low-cost market-based ETF then. Why have to worry about analyzing the REIT, the depreciation, all these other things that matter? It doesn't work that way. I don't believe there's any such thing as true passive income, especially not in real estate. Now, leads us to point number 4. Third-party management is there to save the day. Guys, do not hire a third-party manager. I just got a text this weekend from a kid, 23-year-old, super smart kid, wants to buy real estate. He says, listen, I keep seeing your videos where you talk about third-party managers. He said, don't do it. And I said, yes, do not do it. If you can't manage it yourself, don't buy it. Third-party managers are not good. I have hired 10 or 12, I don't remember the exact number, and every time I fire them, revenue goes up, expenses go down, profit surges. Why? A third-party manager is worried about one thing: occupancy percentage. As an owner, you need to be, and following this channel, you need to care about one thing: financial occupancy percentage. That's what you need to worry about. What's the difference? Let me tell you. We owned a property. We owned 300 units in a place called Shaker Square in Cleveland. We had a property that was literally identical, 2 buildings. We owned this one. Our competitor owned this one. When I say the exact same buildings, if you drove down the street, literally photocopy buildings, layouts, everything. Our average rent here was about $1,000 a month. The competitor right here was $750 to $800. Okay. Off the dribble, which would you rather have? Well, we're looking at this saying, obviously 1,000. His occupancy was 95 to 98%. Our occupancy was 92 to 95%. Guess what a third-party manager is going to tell you? Look at us. We're 95 or 98% occupied, and everybody's going to be happy about this. I'd rather have this. I'd rather have 92% of 1,000 than 100% of 750 or 800. That's the difference. There's another property that somebody in our studio currently lives in. A friend of mine owns it. And I've said to him for years, can I please buy your property? He said, no. I said, well, you're leaving a lot of money on the table. His name is Steve. I said, you could really jack up your rents by renovating the units. You know what he said to me? I prefer to have high occupancy. Like, okay, you're leaving millions and millions of dollars on the table. And Nick just interrupted me and said, don't tell him to raise my rent. And I've been telling him this for years. You have to renovate your property and increase your rents. And he literally says to me, I like having high occupancy. Why? He's a bunch of investors and a bunch of people, peasants and idiots who say, well, we have high occupancy. That's great. We're better occupied than you. You'd rather have this at this occupancy than this rent at this occupancy. If you don't see that difference, go to the Grant Cardones of the world. He's the guy for you. He is the idiot who will lead you to less returns. You'll probably still do fine, but that's the world for you. My final point. No money down. Guys, avoid this like the plague. You need to have skin in the game. You need to go in there and be able to put money down, buy a property. It's okay to make less return. No reason to sleep bad at night by wondering about this massive mortgage payment. What's reasonable? 20 to 30% on every property. You might sit there and go, Paul, 20 is pretty high. 20% down payment is pretty low. It can be. We personally like to buy all the time at 25 to 35% down payment, which is 65 to 75% loan to value. Why? Because at this point, we're not worried about the mortgage payment. We can focus on renovating the property, increasing the value over time. Now, a lot of people sit there, it's 100% fact. You'll get a higher return, and you'll see it in our real estate calculator. If you put less down, your return goes up, which is awesome. But also, the swings are a lot bigger when you have a high debt. Zero money down, it's not the world I want you to live in. I want you to sit there and save money, have more committed to the property. You're going to do a better job doing that, and you're going to sleep better at night. This whole idea of no money down, it's purely marketing to get people to sit there and do that. No reasonable bank in the world will let you buy a property with no money down, and you shouldn't go take on egregious 12 or 13% mortgages to get no money down. It's absolutely insane. Your job in making money on a piece of real estate is to manage the property well, not use financial shenanigans to increase your return. Years ago, I remember meeting a guy who bragged about having 140% returns on his property. Why? He was putting 1%, 2% down. When the 2008 financial crisis happened, wiped out completely. Now, do we need that to wipe it? No, when you're putting 1 or 2% down, you don't need that. And the banking world back then was different, but he was wiped out completely. And by the way, guys, let me ask you another question. Would you rather make 140% over 2 years on 1% down, or would you rather make 15 to 20% a year for life on 20 to 30% down? This is the winner. You're going to be massively wealthy on this. Why take this risk? Avoid the no money down scams. They don't work. And guys, if you want to be massively wealthy, watch this next video. Buying one great property per year can lead to $10 million net worth. Thank you for your time.